Welcome back to the deep dive. Okay, so you've brought in some interesting verses today detailing a very specific investment strategy.
That's right.
And our mission really is to cut through the noise,
Yeah.
get to the core ideas. We're looking at a 4-stock portfolio built specifically for passive income.
Exactly. And it's not just about, picking 4 random high-yield stocks. This is structured. It's a diversified engine really designed to kick out reliable cash flow.
Right.
The sources talk about a goal, something like generating a couple of $1,000s per year from say, a $40,000 starting investment. Hypothetically, of course.
And just looking at the mix, it suggests, instant diversification. You've got energy, HVAC distribution, appliances, even a Nasdaq-linked ETF. And the starting yield is pretty eye-catching, too.
Yeah.
The average is cited at 5.8%.
Yeah, it's a fascinating blend, I think, because each piece plays a really distinct role in the portfolio.
Okay.
You've got your income generator, your stability piece, and then 2 more strategic bets on growth.
So who are the players? Let's name them.
All right, we've got the JPMorgan Nasdaq Equity Premium Income ETF, that's JEPQ. Then there's the energy giant Chevron CVX.
Okay.
Then Watsco WSO, they're an HVACR distributor. And finally, the appliance maker Whirlpool WPHR.
Got it. A very diverse group. So let's unpack this. Where do we start? Probably with the cash flow engine, right? JEPQ.
Makes sense.
It promises monthly payouts. And the yield figure mentioned.
Wow. Trailing distribution yield cited at 11.1%.
Yeah.
I mean, that number alone is going to grab any passive income investor's attention.
It absolutely does. But it's really crucial to understand how it's generating that yield. It's not just from, stock prices going up or standard dividends.
Right.
It's an income-focused product, and the strategy is, it's a bit complex. It uses 2 main buckets for its assets.
Okay. Tell us about these buckets.
So up to about 80% of the fund is in regular stocks, equities, mostly mirroring the Nasdaq index, so that gives you your basic market exposure.
Okay, standard enough. What about the other 20%? That sounds like where the yield magic happens. That's pretty much it, yeah. Up to 20% is put into something called equity-linked notes, or ELNs.
ELN.
Think of them as like custom debt instruments.
Yeah.
Their payouts are tied to how the Nasdaq index performs. These notes are really the vehicle for that high-yield strategy.
So ELNs. Let's just make sure we're clear on this. What are these notes actually doing to generate that kind of income?
Okay, so they're constantly actively selling monthly covered call options on the Nasdaq index.
Ah, okay. Covered calls.
Right. So by selling someone the right to buy the index at a higher price later, the fund collects cash up front, the option premium. And that steady stream of premium income is the main driver behind that big 11.1% distribution yield figure we saw.
Okay, that makes sense if the market is flat or, drift down, you just pocket the premium. But here's the big question, isn't it? If the Nasdaq suddenly takes off, rallies hard, doesn't selling calls cap your upside? How much growth are you potentially giving up for that monthly check?
That is the critical trade-off, absolutely. And the JEPQ structure tries to, manage that.
How so?
So yes, if the market jumps significantly higher, the ELN part, the option strategy, it will lose out because those calls get exercised. The fund misses some of that big spike.
Right.
However, the idea is that the main stock holdings, that 80% invested in equities, should also rise with the market rally.
Okay.
And that gain is expected to, offset the losses from the option strategy getting called away. It's designed for strong income, some market participation, but yeah, it definitely trades away that explosive upside potential for more predictability and downside management.
And crucially, that income stream, that cash flow, isn't just passive, right? The sources suggest it's a tool for the rest of the portfolio.
Exactly. It becomes strategic. The monthly income can be used tactically to buy more shares of the other 3 holdings, CVX, WSO, WHR, especially when they dip.
Ah, okay. So you use the ETF's cash flow to enhance the other positions during market weakness.
Precisely. It turns that passive income into an active advantage. You're using JEPQ's relatively stable monthly payouts to build up your other positions when they're cheap. It helps the whole thing compound better over time.
Okay, so JEPQ provides the tactical cash. Now let's talk stability. We shift from the complex ETF to the portfolio anchor, Chevron, CVX,
Right.
integrated energy major, yield around 4.5% based on the data. This feels like a pick for the more conservative investor looking for some resilience.
Definitely. And if you want to understand its stability, you really need to look at Chevron's integrated structure. It's key. The business is basically built on a natural hedge, upstream and downstream.
Walk us through that again quickly,
Yeah.
because that balance seems important.
Sure. So upstream is, finding and pumping oil and gas, exploration and production. That part does really well when energy prices are high.
Naturally.
But if energy prices fall, the downstream side, refining oil into gasoline, making chemicals, tends to do relatively better.
How's that?
Well, their main input cost, crude oil, gets cheaper. So refining margins often improve. This kind of built-in counterbalance helps smooth out the cash flow.
Okay.
And that helps protect the dividend, even with moderate swings in oil prices.
But energy stocks can be volatile, right? I mean, what if oil crashes hard or stays low for a long time? How much protection does that upstream-downstream balance really offer before, say, the dividend is at risk? You need more than just the model, surely.
That's a fair point, a really good question. And the answer, I think, lies in their financial strength, their balance sheet.
Okay.
Look at the numbers cited in your materials. Wall Street expects Chevron to generate something like $47.8 billion in EBITDA in 2026. Huge number.
Yeah.
Now, compare that to their expected net debt, around $37.7 billion. You see, they have massive financial capacity there.
Low debt relative to earnings power.
Exactly. The debt's manageable, cash flow is strong. That provides a really significant buffer against downturns, much more than just the integrated model on its own could offer.
So for that conservative investor, CVX gives you maybe some upside if energy prices cooperate, but also this deep financial foundation for protection if things don't go perfectly.
What is
solid anchor?
That's the idea. It's the counterbalance to some of the, let's say, more potentially volatile parts of this particular mix.
Right. Okay, so that brings us to the other two. The ones picked more for aggressive upside potential, though they seem to be facing some headwinds right now.
Correct.
Let's start with Watsco. WSO, HVACR distributor, yields about 3%. Now, it might be down over the last year, but the long-term history.
Yeah.
Pretty amazing.
Amazing is definitely the right word. I mean, look at the total return figures the sources mention, with dividends reinvested, over 300 and 370% in 20 years.
Wow.
Yeah. Watsco's been one of those quiet compounders, often flies under the radar, but it's outperformed like crazy in its sector.
So, given that track record, why the recent slump? Down over 17% in the past year. What's causing this softness?
It's a bit technical, actually. It's a regulatory thing highlighted in the sources. The whole HVAC industry is going through this big mandatory change driven by environmental rules. They have to switch from older refrigerants to newer ones, A2L refrigerants, which are better for the environment.
Ah, okay. A forced transition.
Right, and that kind of change always creates, uncertainty, maybe some inventory issues, temporary slowdowns for distributors. That's what's causing the current soft market conditions.
But the upside case depends on getting through this transition smoothly. But beyond just waiting for the regulatory dust to settle, what's Watsco actually doing to drive growth? What are the internal catalysts?
Well, it really comes down to two main things strategically. First, HVAC distribution is super fragmented, lots of small players. Watsco is a master consolidator. They consistently buy up smaller regional distributors.
Okay, M&A.
Right. But second, and maybe more importantly, is how they do it. They call it a buy and build strategy.
Buy and build. Let's focus on that. How does that turn a small acquisition into a real growth engine?
Well, they don't just buy these companies and, strip them down. They enhance them. They acquire the smaller player, keep the local managers, the customer relationships, that local knowledge is valuable, but then they layer on Watsco's own tech and supply chain muscle.
Ah, so better systems, better buying power.
Exactly. Think superior inventory management, better pricing because of scale, access to this huge, efficient product network. This tech and scale injection lets those acquired companies boost their efficiency, gain market share, and really drive growth after being acquired.
Got it. So it's a structural advantage, not just buying revenue. That makes sense as a growth angle.
Right. It justifies seeing it as a growth asset, despite the current refrigerant hiccup.
Okay, clear structural driver there. That brings us to number 4, the final piece. Whirlpool, WHR, yielding about 4.7%. Now, this selection seems almost entirely about external factors like economic policy.
It is definitely sensitive to big outside forces, yeah. Two main ones. First, and maybe less critical right now according to the sources, is interest rates. Whirlpool sells big-ticket appliances, right? So they're tied to the housing market, consumer confidence. Generally, lower rates help housing, which boosts appliance demand. Pretty standard linkage.
But the sources really emphasize that the main story here the potential for like massive capital appreciation isn't about rate cuts. It's all about trade policy, tariffs.
Absolutely, that's the core thesis. The primary upside case rests almost entirely on these new tariffs being imposed on competitors, particularly from Asia.
How does that help Whirlpool specifically?
Well, it's a huge potential shift because Whirlpool makes something like 80% of what it sells in the U.S. right here.
Ah, domestic manufacturing.
Exactly. So tariffs on imported goods make Whirlpool's domestically made appliances significantly more competitive on price within the U.S. market.
So government policy is basically building a kind of competitive moat for them at home.
Mm-hmm.
If that's the case, though, why isn't the stock already reflecting that? What's the drag right now?
It's all about the timeline. That's the current drag. Right now, Whirlpool is dealing with a tough spot because those competitors, knowing the tariffs were coming, they basically flooded the U.S. market with inventory before the tariffs fully kicked in. They preloaded.
Ah, so Whirlpool is currently competing against a wave of cheaper pre-tariff inventory.
Exactly. It's like a temporary distortion caused by that stockpiling.
Okay.
So the sources are forecasting, well, a pretty marked improvement starting next year, 2026.
Why then?
Because by then, that preloaded inventory should be mostly sold through. Competitors will then face the full whack of the tariffs on all their new imports, and suddenly Whirlpool's domestic production looks really advantageous from a cost perspective.
Got it. So the investment is essentially a bet on that earnings turnaround in 2026, driven by protectionist trade policy actually taking effect.
That's the core bet, yeah. An inflection point driven by policy.
What an interesting combination of assets this turns out to be when you break it down.
It really is.
You've got JEPQ kicking out monthly cash, which you can then use tactically.
Yeah.
You've got CVX providing that stability, that sort of countercyclical balance to protect the core investment. And then WSO and WHR offer this targeted potential for growth, but driven by really specific, almost non-cyclical things. Regulations for Watts Go, tariffs for Whirlpool.
And that strategic balance, that's the shortcut, that analyzing these sources gives you. It's not just about chasing yield.
Right.
It's about understanding how these four very different gears mesh together. You've got risk management built into the Chevron pick. You've got market volatility management sort of built into JEPQ's option strategy.
Yeah.
And then these specific growth drivers in Watts Go and Whirlpool that seem potentially undervalued right now because of these temporary issues.
So wrapping this up, if you, the listener, are thinking about building a resilient, genuinely passive income stream, what's maybe the single biggest takeaway from digging into these sources?
I think it's that you absolutely have to look beyond just the headline yield number.
Oh.
A high yield doesn't mean much if the underlying investment, the capital, just erodes away over time.
Right. Sustainability.
Exactly. The key is analyzing the mechanism, like how JEPQ actually generates that income with covered calls, and understanding the powerful, sometimes complex external factors, things like tariffs or industry consolidation or regulatory shifts. These are the things that drive the potential for the capital to grow within an income-focused portfolio.
So focus on the durability of the capital base itself.
Because that's what ultimately ensures the income stream can last. It's about the whole picture, not just the dividend payment.